Growing your money one rand at a time. It's Quintessential Finance.
Money in the bank.
We're talking to Candice Paine here on Quintessential Finance. It's our maiden voyage into investing here on the podcast. Candice Paine, how are you doing today?
Hi, Quintus. Very well. Thanks for having me on your show.
No, very good. Thanks for taking some time out. I know you must be quite busy down there in the Cape. And I mean, you've got a lot of things to stress about being in the Cape in itself.
Gathering water mostly.
Candice, before we get to who you are and what you do, I've got a bit of a Biz News article quote that you wrote. You said, "Don't shy away from getting advice. Life is too complex to be an expert in everything, so outsource the gaps. A good advisor will in fact keep you honest to every point." Which is really half the battle won in wealth creation. So now you are that person to me. So that's coming true now.
Yes, but I am that person to you, Quintus, and well done for reaching out.
So, I mean, you know, the millennial investor, the South African born-free generation is now getting into workplaces and they are essentially getting salaries. So I thought, what better way to start these guys off on what the best practice is when it comes to investment. But Candice, give us a little bit of a rundown quickly of who you are and what you do.
So, Quintus, I'm at heart a independent financial advisor. So I spend a lot of time with individuals talking about how are they going to grow their money, where they're going to invest it, how they're going to structure it. But my background, I come out of a research background. So I've spent many years in South African asset management companies doing research, economic and fund research, and I still spend a lot of time consulting back to those asset managers around things like their products, how they structure products, price products, looking at underlying funds, competitors, that kind of thing. So I would say that I am a holistic generalist when it comes to wealth management.
Well, there you go. I think we're talking to the right people then. You know what? Let's start in terms of what we're going to be talking about. And this is all about exchange traded funds. Now, I'll let you know, I read 2 books when I thought, you know what, I'm getting a salary now, I need to start reading some books. And I read some American stock market books. And a lot of the information in those books was very, I would say, detailed. But there were disclaimers at the end of every chapter that seemed to say, but the sensible investor would choose an exchange traded fund. I mean, even Warren Buffett has said he's going to put most of the 1% of his wealth into, you know, for his wife and his family, he's going to put it into an S&P 500 exchange traded fund. So as a young student reading these very complex words, exchange traded funds, I wondered, what exactly are exchange traded funds? So Candice, could you explain to us what are exchange traded funds and why should every South African investor be investing into them?
Yes. So exchange traded funds are, as the name implies, it's a fund that trades on an exchange being a stock exchange. So what we tend to do in finance is complicate everything, but if you break it down into its component parts, it's very simple. Mostly what funds do is they invest in a whole basket of shares. And what a fund manager is trying to do is outperform the market, outperform an index. What an exchange-traded fund does, it says, we don't think that we can outperform an index. All we want to do is track an index. In its simplest form, we just want to track the index. So it may be the FTSE JSE top 40. The exchange-traded fund will buy those 40 shares in the ratios that they appear in the index, and the fund will just track the performance. So if you bought that ETF, which trades as a share on the JSE, your performance over time would be the performance of the FTSE JSE index. That is the simplest version of an ETF. There are many, many different kinds of ETFs that are tracking different indices that have different exposures to different industries and sectors, but they all are based on that premise that they track an index, and therefore you can access them relatively cost effectively and simply by just buying one share you get the whole index.
If we are talking about, you know, the most sensible move you can make as an investor, would you say exchange traded funds are a sensible move?
I think everybody should be investing, and I think everybody should be saving. Where you save and invest very much depends on the time frame that you have. So I would say the silver bullet with all kinds of investing is time frame. You need time for value to unlock. So if you're saving for your retirement and you're very young, absolutely have ETFs, have basically equity exposure and money in the stock market. If you're very close to retirement, which I'm sure your audience isn't, you would be looking at dialing down the risk in your investment because you're going to be spending it quite soon. So this is where the advice part comes in. But if I had to broadly say, should everyone own ETFs? I think everybody should be investing. Where they invest is up to them to do some of the research about, where their money actually ends up.
Yeah, absolutely. But one of the benefits of ETFs, and that is also some sort of, recent thing that a lot of students are starting to hear, is that they can put it into a tax-free savings account. So when we hear tax-free savings account, are we truly getting returns in a tax-free savings account that are genuinely tax-free?
Yes, you are. So this is possibly the only free lunch that our government is ever going to give you, and you should take advantage of it 100%. So the way that the tax-free savings account works is if on any of your investments, you will pay tax on the capital gain, so that's the increase in the share prices basically. You will pay tax on the interest income that you earn. So if you have money sitting in a bank account and it's earning interest over a certain amount, you're going to pay tax on that, and you pay tax on dividends. At a rate of 20%. You can't get away from that no matter where you invest. Some of your pension funding is tax-free, but for your discretionary money, which is your after-tax money, your savings really, there's no place that you can get away from paying those taxes. So what the government has said is up to a lifetime maximum of 500,000 Rand, you can invest 33,000 Rand a year in a tax-free savings account. So think of the tax-free savings account as a wrapper or a box with rules on the side. You put your money in there, and the money that's in that box is subject to the rules on the side. And what the rules say is you can basically invest your money anywhere, and the earnings are tax-free. So it really is tax-free. And the benefit of the tax-free savings account, once again, comes out in the time frame. You need to do the time. So you need to put as much as you can in each year. If you can put 33,000 Rand a year in each year, all the better, and then sit and wait out. Because it really is only after sort of 10 to 12 years that you start seeing the tax-free benefits if you don't touch the investment. So this is where the power of compounding comes in. Your money will compound over time, especially if you've invested it in something high risk. And over long periods of time, your capital gains will grow, your interest income will grow, your dividends will grow, and all of that will be tax-free. The thing about investments and where people make mistakes with investments is they keep dipping into it. Many of my clients will say, but property's been my best investment. It's also been the only investment that they protect, because when you need money, you can't sell the front door. So people find money to pay their bond. They find money to look after their house. They stay in it for 10 years plus. And that's why they reap the benefits, because they're actually doing exactly, they're showing that investor behavior that means you're going to succeed. Whereas with something that's more liquid, like unit trusts or ETFs, if you can dip into it, it's so easy. And that's when you start destroying the value of the investment that you're actually trying to build up over time. So yes, Quintus, that was a long-winded way of saying everybody should be taking advantage of their tax-free savings account.
Together, you and I have been mulling over a basket that we want to put together to potentially say this might be a good roadmap for young investors who have the time to put their money in and let it grow. So we're going to be listing what we call the Quintessential Basket up on Easy Equities' platform. So we spent about 2 weeks or so going over this, and I, being the millennial investor who doesn't know too much about it, asked Candice to help us out. Now, Candice, we've built a list of about 5 ETFs that we think you should be putting your money into. So I think what students would love to hear is if they now got something like an MSCI World, for example, and that's an ETF. 45% of the Quintessential Basket goes to MSCI World. I think what students would love to hear is what stocks they can potentially own when they invest into this ETF. So is it true that once you invest in this ETF, you basically own the stocks?
Yes, you absolutely do own the underlying stocks because you own the ETF, and the ETF is investing in the underlying stocks. So just for anybody listening, any of the ETFs that are out there on the JSE, they all have something called a minimum disclosure document, which you can Google. And what that tells you is everything you need to know about the ETF that you're investing in, including usually the top 10 underlying stocks, because the top 10 usually make up the largest percentage of what you're investing in. So if you are in any way in doubt about, where something is investing, go and look for this document. Just type in the name of the ETF into Google, and it'll direct you to the minimum disclosure doc that tells you what's going on. So, for example, the Satrix MSCI World, what that does is it invests in developed markets globally. So none of we are an emerging market, and so what we want to do is diversify away from emerging markets with our money. So it'll be including obviously large portions of the US, the UK, Europe, Japan, those sorts of developed markets. And with one trade, you get access to over 1,800 different companies globally in your ETF. So you're also getting exposure to industries and companies and markets and sizes of markets that you just don't have in South Africa. We represent less than 1% of global GDP. We're tiny. And we just don't have industries or listed companies where you can gain access to industries in this country. So from a South African point of view, it is hugely important that you do have that offshore exposure, which is, Quintus, why I think it's such a great idea that you've put this into the basket, the MSCI, and it's also really good that you focus on developed markets. Because we are an emerging market. As sophisticated as we think we are still an emerging market.
Now, I think there's a huge rise of, these stock brokering companies that are, I know Satrix also has Satrix Now, where you can do your tax-free savings accounts and buy ETFs in them. And that's the thing here. I think something is rising up to tell people, listen, the South African savings culture can be developed, because we need to do offshore investing. We also need to do a little bit of onshore investing, and we even need a little bit of what we call the fourth industrial revolution stocks available to us, because we as young people, I think, want to be invested in the future of robotics and solar panels and renewable energy and all of that kind of stuff. But we still have slow to develop savings culture in South Africa. So would you say that ETFs as a vehicle could improve the savings culture we have in South Africa when it comes to putting them in tax-free savings accounts?
I do hope so. What companies like Satrix and Easy Equities have done is that they've tried to reduce the barriers to entry. So traditionally investing was a long involved process using, long forms that needed to be downloaded and faxed in the old days. Money needed to be deposited. Now, what companies are doing is trying to make it easier. With online apps, Easy Equities, if any of you have used it, you'll know that it's very simple. The Satrix Now app is just Easy Equities white labeled, so it's exactly the same thing, but keeping it to Satrix ETFs. It allows you to invest either your discretionary money or your tax-free money, and through these initiatives, we really are hoping that people will start saving. And I think, one of the biggest, the biggest pull towards Easy Equities is that there are absolutely no minimums. So literally, if you only have R3 to invest, you can open up an Easy Equities account and start investing on the stock exchange or in global shares. So there really is no excuse. You're not held to debit order minimums or large upfront lump sums. It really is whatever spare change you have at any time, you can start investing. And slowly through that process or through that discipline, these companies are hoping that we will encourage South Africans to save, because we don't live in a country where the government is going to look after us. We need to be growing and creating wealth and spreading this kind of information and this kind of education so that people are able to look after themselves from a financial point of view.
Yeah, no, I think the couple of ETFs that we have put in there really does represent some sort of global approach to being part of the global economy as a person who has 20 to 30 to 40, maybe even 50 years to spare to put money into an ETF. But I think it's definitely something to consider.
The most value that I have seen destroyed with people's money is when they chop and change or chase fads. So, even Warren Buffett would attest to this. Don't invest in something that you don't understand. And when you need to, time really is the most important thing in investing. Put your money in something that is solid and leave it alone. Some years you're going to do less well than your peers at the BRI. Some years you're going to do more well than your peers at the BRI. But I tell you what will make you do a lot better than everybody is just consistently leaving your investment in a solid investment over time. Because the power of compounding and for all your sort of maths and stats and engineers, etc., out there, and accountants who can do this maths in Excel. It is the seventh wonder of the world. It is a phenomenal thing, that power of compounding, and you only start to see it after long periods of time, like 7 years and onwards. Which I know in a millennial's lifetime, they can't see 3 minutes into the future, never mind 7 years. But if you could stick to one thing in your life, just put the money in and leave it alone. And I think that the basket that you've put together, Quintus, is fantastic. If I can just comment on it a little bit more, the discussions that we had. So one of the things that you wanted to do was the offshore exposure, and we got up to 60%. So we've got 60% offshore exposure in the basket and 40% local exposure. And the offshore also includes emerging markets. So it also includes countries like India and China, where economic growth is booming because people have spending power. There are far more young people in those economies than there are in the developed world. A lot of the tech world is coming out of places like China and India. So we've been able to combine, the developed world with the emerging market world on the offshore side. And then your South African exposure is also fantastic. So we haven't just gone for straight vanilla market cap indices in the FTSE JSE Top 40, which is a great index, I must say, but we've gone for something called Smart Beta. And your listeners might want to read up a little bit more about Smart Beta. It's a different way of chopping up an index so you get different exposures. And the ones that you chose there are the quality index and the momentum index. And the quality one was great, as we discussed, because it's looking at sort of solid companies that have good earnings growth, good cash flows, and your momentum are more of your growth companies, the companies where prices are moving up, earnings are being revised upwards. And the combination of that on the South African side means that you really have encapsulated the essence of the South African market. So I think, well done, a great job to you for your tax-free savings basket.
Definitely. I'm excited to get more students and young professionals because, like I said, when I started getting a salary, it is that feeling of, I'm getting money now, but how am I going to make this money grow? Because, when you're getting a basic salary, you sit there and you're like, surely this can't be it. But people must know that there is a vehicle that can make their money grow. And I think something like this, a basket full of ETFs, is potentially, the one thing you might need, because a lot of people feel really very scared about investing for the first time. I'm sure you might know the first time you invested, it was kind of like, I'm going to really, really break out in a cold sweat here, because investing is a bit of a scary thing. But do you think that this pulls back the curtain on the scary part of investing? This I think does come closest to making people just feel a little bit more at home when it comes to investing.
Yeah, I think we are definitely lifting the lid on investing and making it more accessible for people. It is a scary thing. Parting with your money into some black hole that you don't really understand is a scary thing. But I think more and more people are talking about their money. That's something that we as South Africans don't do. We don't talk about money. And they're starting to talk about their investing. If anything, I hope that the peer pressure makes people start investing, if nothing else does, just to be able to say that you do have your tax-free savings account and that you have not touched it. I think that would be great for every South African. And I think that, yes, you're going to make mistakes in the beginning, and that's why you probably don't have a lot of money in the beginning. I'm hoping not a lot of money in the beginning so you don't lose it, but over time you'll get better at it. And as I've said, in the quote that you read out, if this is not your thing, you still have to look after your money. Go and get advice. Don't ignore it. Just because it's not your thing, don't ignore it. We all need to be looking after our money. And start investing today. It really is that important.
It's a rich man's world. Quintessential Finance on the Quintessential Show.
Money in the bank.